quiz is going to be, guys, is one of these problems, and that's all. I'm just going to do one. Do a full cash flow statement. All this cash flow statement is an analysis of the balance sheet, the changes in the balance sheet. You guys know how to do a balance sheet and income statement, right? No big deal, okay, at this point. All we're going to do is we're going to take every change in the balance sheet and write it down on a sheet of paper and call it a cash flow statement, right? Okay. So it's just the changes in cash. Where did the cash come from and where did it go, right? A lot of people like this statement a lot. Some of us don't think much of it. I think the reason, in my experience working in public accounting with clients, people like it a lot because they know what cash is. When you guys started this class, did you know what cash was? You know what cash is, you got it in your pocket, right? You know what cash in is, you know what cash out is, and that's what this statement shows. And then they want to run their business with this. Do you believe that the amount of money you're making is represented by the amount of cash that comes in? Not even close. You could be losing a fortune and have a lot of cash, right? Or you can run out of cash when you're making money. How could you run out of cash when you're making money? You're building your business, your receivables are going up, right? You haven't collected it yet. You sold a lot, but you haven't collected it yet. If it's collectible, of course, it's still an asset, right? And you've got inventory building, you're building all kinds of stores. So do companies run out of cash that are making money? Yes, you can even go bankrupt that way, believe it or not. So do you want to manage cash? Sure, you don't want to run out of cash and not be able to make your payroll even though you're profitable. And that happens to startup businesses all the time. When we say business is undercapitalized, we mean the investors did not make a big enough investment, and you did not arrange enough financing early, arrange enough debt early, to make sure you could cover all your operating expenses as the company grows, huh? So if you're growing way too fast, whatever that means, right? If you're growing too fast, you always want to grow, probably, right? But if you grow too fast and you're undercapitalized, what can happen is you run out of cash, and then you know what you do? You have to go ask for money. When should you ask a bank or an investor for money? When you need it or when you don't need it? When you don't need it. If you have to have it, they've got it. So, you're starting your business, get things really going, it's all fired up, you run out of cash, and you start talking to people who happen to be wealthy or happen to be bankers, right? The bankers want tremendous interest rates to tie your hands on everything you can do with the business, all kinds of covenants. You guys read about those, right? So they're going to run your business for you now, kind of, because you're irresponsible, ran out of cash, I guess, right? Okay? And they're going to take most of your profits and interest. Or if it's an investor, what do they want? A minimum of 51% stock ownership. You are now employed. Right, guys? You know what 51% means when you vote, right? We just did consolidations. So you want to manage cash. So I'm not saying that you don't want to be careful with cash, but don't use that to evaluate whether or not you're making money. The income statement gives you a statement about how much you're making or not making. Don't use it to evaluate how strong your company is in terms of debt versus equity, that sort of thing. And we'll do financial analysis in the last chapter. You'll look at a few of those things. Use that information, right, to predict what's going to happen in the future. I can make cash flows better. You know how I can make cash flows better? Go to the bank and borrow a whole bunch of money. I have a lot more cash. Am I richer? They told us that my wife and I are qualified to buy $1 million house. I just cracked up. I thought it was hilarious. We have a $200,000 house, you guys. But our income level, when she was working too, both of us, right? Our income level qualifies for $1 million house, plus the equity we have, the investments we have, all that stuff. I just laughed at it. And well, we kind of like to be approved for $200,000. And like, you're kidding, right? No. Which house can you live in? What do you need that for, right? So just because you could borrow the money, should you? I kind of doubt it. Why would you do that? Same with a business. When should you borrow money? When the cost of the money, whatever interest you pay on it, or whatever you have to give the shareholders, is less than you're going to earn with it, right? Only for sure you know how much you're going to pay in interest, right? Or how much the shareholders are going to demand. But don't you know for sure how much you're going to make? That's the risk idea, right? Talk about risk-return trade-offs, okay? Right? The more risk you take, the more expected return you get. I say expected return. What's the difference between expected and real? It's the risk. You might expect a lot, not get it, right? Okay, so we try to estimate. That's what we're going to use to estimate statement or income statement? Income statement. You can't manipulate it. You can't go borrow a whole bunch of money and say you're richer. You can't not maintain your building and your equipment and say you're richer. You're not richer, you're destroying the business, right? If you don't maintain things. You're not richer if you borrow a whole bunch of money, you just owe more money, right? How do you get richer? Sales revenue more than operating expenses, or more than expenses in total, right? Cost of goods sold, operating expenses. Everybody agree with that? Okay, it's basic, isn't it? Okay, so all we're going to do here, and I'll do this real mechanically at first, and then we can talk a little bit about, and we just did talk a little bit about, I guess, the theory behind this. But we'll do this real mechanically to start, okay? And we're going to use things you already know. And again, one problem. Learn how to do this problem, nail it on a quiz, nail it on the test, nail it on the final. We're probably talking about, I don't know, 50 points. All right, guys? Would have had a 50 points up to grade. Yeah, so get them, okay? Like most of you just did with this quiz, huh? A lot of you really patted your grade with this. It's nice. It's great. There are people who haven't been doing very well who got 20 on this thing. Fantastic. You can do it, can't you? Okay? Apply yourself. Go after it. Learn the stuff and you know it. That's it. So, all right, anyway. So, let's take a look at this thing. What's on this statement? If I was going to start this statement, okay. If I was going to start this statement, I think I would be sure for any financial statement, balance sheet, income statement, cash flow, equity statement, what are you going to do? Write down the company name. Be sure to do that. I'll actually give you points for it. Write down either cash flow statement or statement of cash flows. You like it? Be sure and do that. Okay, so real basic. And then is this for the year ended or a specific date? Let's see, on a balance sheet it's the specific date, right? The author says add it up, but nobody does that. You just put the date, right? Why? Because we never close those accounts. They're permanent, right? Shows the cash that from the beginning of the company it started at zero. All the cash in less all the cash out is the cash in. And every asset, every liability, every equity counts that way, right, guys? We'll go over that over and over. What do we do in the income statement, seeing as you only show 1 year? You say for the year ended. What do we do in the equity statement, seeing as you start with the beginning and go to the end? For the year ended. Guess what we're going to do on the cash flow statement? We're going to show the change in cash for this year. What are we going to call it? For the year ended. No, it's not memorized. It's common sense. Okay? For the year ended, and put the date there. So in this one, what is it, 12/31/2002? Just tell they haven't changed this for a while, right? Anyway, so fine. Statement's been the way it is for quite some time. All right, great. You're going to have that. Now here's the deal. There are 3 sections, and what I would suggest is they're upside down. Okay, helps you remember. They're upside down. We're going to start with operations or operating. Okay, and then we're going to go down about half the page. So as you're setting it up, the heading at the top, then put operations, cash flow from operations. Okay, that's going to be a section. And then we're going to go down about half the page, and we're going to put cash flow from what? Investing. Excellent. And then we're going to go down about half again, 1/4. So I'm 3/4 of the way down the page, and what am I going to put? Financing. Okay? And then when I'm going to get the total for each of those types of things. And we'll talk about those in just a second. Okay? I'm going to add them all up, and what am I going to get? Increase or decrease in cash, whichever one it is. Change in cash. Increase or decrease in cash. And then cleverly, I'm going to add that to the beginning cash. And there are slight variations on the order on these, here at the bottom, right? On the cash part of it at the bottom. So you can do it in a couple of different ways. This works well. This is going to give me ending cash. Would you guys agree that the beginning cash plus or minus the change in cash is the ending cash? Huh? Buy that? Okay. So what I'm going to do is I'm going to go to the cash account for the company. I'm going to write down the beginning cash, the ending cash. I'm going to subtract the beginning from the ending, and I'm going to write it down as the change. And on the test or the final, you will now have a couple points for the heading and a couple points at least for doing that. Okay? And you're on your way. All right? Plus, you know what you're doing. So what did the cash start with in this company? Let's just use this little company to get started. Let's use Eaton, the first 1610, the one that's on the top. That's good enough. And I gave the two problems that are in two different formats. They look a little different. Exactly the same problem, just looks a little different. Right? So just relax when you're doing these. Cash, what did it start with, guys? Jump back in, let's go. Get your brains going again. Okay, remember, how did you guys do really well on this quiz? When I was going over this graph, you were into it. You were intense. You were going for it. Get your head back there, okay? Right? When you go to work, tune in, get to work really hard, and then when you go home, you forget to play success, okay? Be fine with me, I don't care. Not what you have in the past for that. Especially if you be a high-powered manager someplace. You really need to turn it off. Okay? Which is hard to do. But when you're there, turn it on, okay? So do that here too. Do it in all your classes the rest of this semester. It's going to be over soon, right? You just have a couple hundred hours of studying to do between now and when you, yeah, no, it's all. All right. Anyway, so what's the beginning cash? 11, wasn't it? What's the ending cash? I bet y'all can do this. What's the change in cash? 7 what, though? Go up or down? Decrease. Obvious truth. That's true, right? Okay, so what we would say then is, we wouldn't say that, we'd say it's a decrease in cash. Got it? Everybody good? This is just not a big deal. Okay? So we know what the answer is before we start this problem. Remember that when you're doing math classes in grade school, junior high, and they give you the answer? And then you work the problem? It's kind of nice, comforting to have the answer, huh? It's nice here, you know when you've got it done right. Okay? Big deal. Okay? So, all we're doing is we are going to analyze the change in cash, and we've already done that, really, right? But we want to know where it came from. So here's the trick. Listen to this real carefully. I am going to write down the change in every balance sheet account except for the change in cash on this statement, because I already wrote down the change in cash. Got it? So take your problem and put a check mark next to cash. We wrote down the change in cash once. We are not going to do it again. So every single one of those assets, liabilities, and equities, we are going to write down the change in it one time, only once, right? And if you add up all the changes in all the assets and liabilities and equity except for cash, what's it going to add up to? The change in cash. Got it? Because debits equal credits. This is going to be real easy if you get your head around it, okay? And then there's a few things you have to figure out where they go, so which makes this a little bit difficult. But mostly, that's it. Okay, now let's think about that balance sheet. Take a look at the balance sheet there. You know that on the balance sheet you have assets, liabilities, and equity, don't you? And you know on the income statement, we've never seen this before, revenues and expenses, which gives us net income, which of course becomes part of equity through retained earnings. Right, guys? You know how this thing works. All right, I want to write down all the changes in the balance sheet. Why don't I want to use the income statement? Because the net income gets added to what? When you close revenue and expense accounts, where does net income go? Retained earnings. Where would a net loss go? It'd be deducted from retained earnings. If I write down the change in retained earnings, guess what I've done? I've written down the net income or the net loss. Got it? So in this statement, when they write down the net income or net loss, they're explaining part of the change in retained earnings. What's the other change you might have in retained earnings? Real common. You earn a net income and then the owners want what? A dividend. So we're going to have to write the dividend down too. Make sense? So for some of the accounts, I am going to, on the balance sheet, I'm going to write 2 lines on this statement, and some I'm only going to write 1. You got to figure out when you're going to do that. And here's sort of the rule. The ones where there are lots and lots of transactions, debits and credits, like all the current assets and current liabilities, for instance, right? Those are the ones. How often do you debit accounts receivable? Every time I sell an account. How often do you credit accounts receivable? Every time a customer pays me. Millions of times in a year in a big company, right? Get the idea? Right? It's over and over and over and over. All we're going to do there is show the change in the current asset. For accounts receivable, for inventory is going to be that way because you buy inventory over and over and you sell it over and over, right guys? For accounts payable, the same thing. Because I borrow on account, debit inventory, credit accounts payable over and over and over, and then I debit accounts payable and credit cash over and over and over. Lots of transactions. Millions of them, right? So I'm only going to show the change. So on the current assets and current liabilities, I'll only show the change in the statement. But let's think about the non-current assets. Land, building, equipment. Goodwill if you want, right? How often do I buy this stuff? Rarely, and how big are those transactions? Huge. So on the current assets and current liabilities, they tend to be millions of transactions in a big company and small ones, right? Small relative to the total of the company, right? Because there's so many of them. That makes sense? Versus on the non-current assets, they're huge, aren't they? Right? Buying a building, selling a building. Got the idea? So we show both the purchase of it and the sale of it, right? We show two lines for that. Got it? I purchased some and sold other ones, okay? Got the idea? That'd be true for all the non-current assets. How about non-current liabilities? How often do you issue bonds? Daily? I don't think so. Certainly not 1,000 times a day, right? Maybe once a year. Got the idea? How often do you make payments? Semi-annual bond, you guys? How often do you make payments? Twice a year, and that's interest anyway. It's not principal. How often do you make principal payments? Maybe when the bonds due, right? Rarely. Okay, got the idea? So what are we going to do with the long-term debt? Same with issuing mortgages, the viability stuff. What are we going to do with the long-term debt, everybody? Show both borrowing it and repaying it. Got it? Same going to be true with the dividends from equity. Okay? Or issuing stock or buying back treasury stock. Okay? By the way, have I mentioned any transaction that we have not covered? No, because we covered all of them. How many additional transactions do you have to learn? Debits and credits, you have to learn to do a cash flow statement. The answer is 0. No new ones. And you know what's really nice about doing this chapter at the end here? Which is why I saved the whole cash flow thing to the end. You kind of have to look at what you already learned, review it, think about it, right? I don't think you have to go back and study it. You're going to do that for the final. But you sort of think about it, right? Well, what was that transaction? What happened? How does this thing work? Okay? So the cash flow statement is kind of useful for that, too. And I think it gives a little bit of additional information. I think the balance sheet and income statement gives you really critical, lots of information. Cash flow statement gives you a little bit of additional information. Kind of useful for knowing why you ran out of cash or whatever, okay, whatever happened to it. Okay, so what I mentioned was they are current assets, non-current assets, all the ones that are more than a year, right? Then there are current liabilities, non-current liabilities, and all of equity is non-current. Would you guys agree with that? That's not going to be used up, let's hope, within a year. Okay? Good. So here's where we put them. And I told you that I thought this thing was upside down. What do you do first when you start a business? What's the very first thing you have to do? If you want to start a business tomorrow, what do you have to do? Get the funds. Where are you going to get it? You're going to go to the bank and say, would you give me money? I don't think so. You're going to go to anybody and ask them if you can borrow money? The first thing you do? I don't think so. Can if you want. But then what will they ask you? How much are you putting in? Because I'm not putting in anything in until I know how much you're putting in, right? And I'm certainly not putting mine in before you do. Otherwise, I started the business, you didn't, right? You got the idea? So you can't borrow money before you start. So what do you do with this thing? Although my wife likes to buy cars that way, houses that way. It's supposed to get cooler in here, maybe, I don't know, or noisier. So what do you do first? You put your own money in, right? What's that? That's contributed capital, sure. And that's financing. See, it's upside down. So increases and decreases in contributed capital go in here. And what else would happen in equity? Now, you might buy back treasury stock. That'd go in here. That makes sense? Treasury stock if you have it. Okay? And what else would go in here? I'm going to put net income up here under operations. Why am I putting net income under, or net loss? By the way, if it's net income, it's a positive number. I have more cash if I make money, right? You pretend nothing changed. Everything was for cash, right? So if I have net income, it's all cash. There's no such thing as accruals and deferrals, sort of the way we think about this. We handle those with the changes in current assets and current liabilities. So net income or net loss goes up there. Well, that's part of retained earnings in equity, right? Okay. Contributed capital goes down here in treasury stock if you've got it. So increases and decreases in equity accounts, right? What's the other big one? I already mentioned it. Retained earnings can go up with net income or down with net loss, but what else can happen to it? It could go down with a dividend. Good, so the dividends would go down here. And the reason is all that stuff is equity. What are your two major sources of financing in a business? Yourself, right? The equity, right? So all the equity went down here. I'm going to show both increases and decreases in it. If I issue a bunch of stock, right, I show that. By the way, it's credit common stock, and we pretend it's debit what? Cash, whether it is or not. Got it? So you can all just think about the journal entry. If I paid a dividend, what would I do? I put it down there, but then what would that be? Debit retained earnings and credit cash. So I put brackets around that one. Remember what we're doing here is cash, right guys? So, do the cash side of what it must have been. That's it. What's your other major source of financing, of course? Non-current liabilities. So increases and decreases in non-current liabilities go there. All of them. Getting the idea on this? So the first thing I do is I put my own money in, that's the equity. Increases and decreases go there, with the exception of net income, which is going to be from operating the company, of course, right? So I got to remember that's separate. And then all the other equity accounts go down here under financing, and all of the non-current liabilities go down here under financing. So if I issue a bond, that's cash coming in. Make sense? Debit, cash, credit, bonds payable. If I pay off a bond, right, or a mortgage payable or something, that's cash going out. Debit the liability and credit cash. Everybody good with this? Not hard, is it? Then what's the next thing you do if you're starting a business, probably? Maybe invest in some fixed assets, huh? Some trucks. Maybe if you're crazy, land and buildings, although hopefully later for that. I lease it first, it's me. Okay? But yeah, so you're going to buy some equipment, okay? So we're going to buy some assets to get things going. So investing in non-current assets both increases and decreases, which means buying them and selling them. And I pretend they're all for cash. So what happens is I debit land and credit cash. I didn't really, probably a mortgage payable or something, but anyway, that's what I did, okay? I pretend it was all for cash. And then what do I do when I sell a piece of land? Debit cash and credit land. Got the idea? Any non-current asset's going to work that way. So as soon as you know you have a non-current asset, it's part of investing. That's what I invested in, okay? And then everything else is operations. Why do you have accounts receivable? Nobody wants them. Why do you have them? So my customers will buy more from me, right? Debit accounts receivable, credit sales. I'd really rather have the cash, but if I don't grant credit, she does. She steals all my customers. Got it? Okay? There aren't too many of them. So I'm going to debit accounts receivable and credit sales. I really want the sale. Actually, I really want their cash. Okay? And then they're going to give me cash later, right? Debit, cash, and credit accounts receivable. So accounts receivable is just debit when I sell stuff and credit when I receive the cash. It's just this intermediary thing going on. Inventory is the same thing. I don't want inventory. Walmart doesn't want any inventory. If you'd send them their money, they would have no stores, no trucks, no employees, and no inventory, right? If you just send them your money. You won't, right? So what do? They buy big boxes and fill them up with a bunch of crap that people come there and buy and give them their cash for. What they want is your cash, of course. So the inventory is just for operations. The receivables are just for operations. Prepaids. Who wants to pay anything in advance? Nobody. Why do you pay your car insurance in advance? Because you can't pay later. They won't let you, right? You have to give it to them in advance. They're big and powerful. Besides, if you agree to buy the insurance and then you don't get in a wreck, you're supposed to pay later or you have to pay. Oh, I didn't need it after all. I didn't really buy it. So you have to pay up in advance, right? Okay, you got to pay for it in advance. So what are prepaids for? To run your operations. Right? We need to pay the rent in advance, or we need to pay the insurance in advance in order to operate. It's part of operations. Same thing with all the current liabilities, right? Why do I have accounts payable? Because I can. I love accounts payable. What do I love about accounts payable? You don't pay any interest on it. I would like to borrow $1 million and pay absolutely no interest on it. Debit inventory, credit accounts payable. It's always $1 million balance. You never have to pay any interest. It's interest-free borrowing. You like that? From your suppliers. Wonderful thing, right? By the way, if you want more accounts payable and you're able to pay with the cash that you have, no, that's called bankruptcy. Okay? But it's still wonderful. Zero interest debt that you can earn a positive return on. You like that? I've had clients, and I've analyzed a whole bunch of large companies with students, where they're borrowing at almost nothing, and they're earning 10, 12% on those borrowed funds, and you get to keep it all. It's nice, isn't it? You don't have any interest-bearing debt. Negotiate really good terms. I've actually had clients where they buy inventory, and they get 90 days to pay for it. They negotiate 90 days to pay for the inventory, and by the time they have to pay for it, They have sold the product and collected the account receivable. What do you think? I've had clients that sold everything for cash, had no accounts receivable, and had 90 days to pay the payables. And they're turning the inventory fast. Man, what a gold mine. What a gold mine. I mean, you look at their balance sheet, it looks a little funny though. You might have a lot of cash because they can't get rid of it. Figure out what to do with it. They have no accounts receivable. They have very little inventory because they're turning the inventory constantly, and they have huge accounts payable. If you were to look at that, bankers would look and say, oh my gosh, they're in real trouble. No, they're not. They're a money machine. No problem paid it off at all, right? So, by the way, you hang on to that cash. Where would you put the cash that you're going to need later to pay the payables in case your business slows down? Cash just did it. Where would you put it? In what? In a bank account? Cash? I don't want it there. What do I want to get off that money? I don't want to have to sit there and earn nothing. I want to earn either interest or dividends and stock appreciation. Where do I put it, you guys? Trading securities, so I'm going to need it really soon, right? Other companies' stock, right? And their bonds, right? And what else? Available for sale short term and available for sale long term, depending on what? When am I going to need it? And I plan what I'm going to use it for. If I'm going to expand my plant, I'm going to build a new building, right? And buy a whole bunch of equipment, expand my business, and it's going to be 5 years from now, I probably don't have the money in trading securities because I'm not going to sell it in a few days. When am I going to sell it? I don't know, in 5 years maybe. But do I want to keep the money? Sure. Then you might even appropriate retained earnings. You look at that too, huh? So that's just send a message to shareholders that you're not giving them dividends because you're going to expand your plant later. What if I'm going to pay accounts payable with it though in 90 days? Might be a trading security or an available sale short term, huh? So I put my investments based on when I'm going to need the money, huh? It's a good idea. My wife and I have all of our investments in the stock market that are kind of a pain to sell off. We have to pay tax when we take it off, right? Or when we sell it off, right? We have to pay tax when we sell it off. Why are we doing that? Because I'm really young and I'm not retiring forever, right? Okay? I'm almost going to double before I retire. Why not? The market will probably do that. Right, guys? So it's in longer term stock. You need it now. Okay? My wife would like to have it now. She's looking at new cars. God. A lot of sticker shock going on there. I can't believe the cars went up by 50% when inflation was only 2% a year. In the last 8 years, cars went up 50%. That's not 2% a year. That's a lot more than that. I don't know what happened. Actually, everybody got excited about buying cars. They tell you that the average car loan now is well over 6 years. I can remember when the average car loan was 3 years. You had to have a down payment for all crazy things. They didn't know how to make money back in those days. Okay, anyway, they make the money off the interest. All right, anyway. So everybody got the idea? Non-current assets I put in here, right? Okay. And the current assets and current liabilities, where do they both go? Over in here, right? So I'm going to show both. I'm going to show just the change in the current assets. I'm sorry, and just the change in the current liabilities. Now let's talk about that. Okay. Oh, by the way, notice we have taken care of equity. It goes down under financing, right? And the net income goes up here. We've taken care of non-current liabilities. It goes down here under financing. We've taken care of non-current assets. It goes under investing. We've taken care of current liabilities and current assets. They go under operations. What's left on the balance sheet? What is on the balance sheet besides current assets, current liabilities, non-current assets, non-current liabilities, and equity? The answer is absolutely nothing. So if you wrote down those changes where they belong according to this, you're done. You can't screw this up. Okay, now why, again, do we put all the equity increases and decreases under financing? Because that's where the financing comes from. Why do we put all the non-current liabilities in here? Because that's where financing comes from. You don't have to remember, it's common sense. Why do we put the assets under investing? Because that's what you invest in, right? Why do we put The net income under operations, because revenues and expenses are from operating. Why do we put the current assets and current liabilities under operations? I don't really want current assets and current liabilities, right? Even though I like current liabilities I don't have interest on. By the way, current notes payable where I have to pay interest, I don't like those nearly as well as accounts payable. Because I have to pay interest on them, right? They're still current liability. Okay, anyway, so why do I have, but why would I even have short-term notes payable? To finance my inventory and my receivables, right? It's all about operations. Everybody got the idea? So that's why they go there. So you don't have to memorize it. It just makes sense. Is this making this seem clearer? Pretty easy. That's all we're doing. Honest. Now the problem is, we are going to end up with some gains and losses that are shown in net income that really relate to investing activity or financing activity, and we have to separate those out. It's the only thing that's going to make this kind of hard. We also have an expense, depreciation expense, and amortization expense in most companies, right? You know what depreciation expense is. It's a non-cash expense, isn't it? Debit depreciation expense, credit accumulated depreciation. We're going to have to handle that too. What we really want to do is under operations, we want to show cash flow from running our business instead of net income from running our business. So we take the net income and we're adding all these deferrals and accruals, adding or subtracting all the deferrals and accruals. No kidding. And we're going to get down to cash basis income. That's kind of it, right? Those of you who do 211, a few crazy ones in here, you do 211, we're going to exactly do this right towards the beginning of the class to adjust from cash to accrual and from accrual to cash, right? You can do it, okay? That's all this is doing, okay? Now let's talk about a little bit more about current assets and current liabilities. Here's what you pretend. If a current asset other than cash goes up, you must have bought it with cash. If it goes down, you must have not replaced it, which would cause you to have more cash. This is kind of true. If accounts receivable go down, what do you bet you collect more cash? If accounts receivable go up, what do you bet you collect less cash? Then what? Then your sales. Then what the net income applies, right? If your inventory goes up and you pretend you buy it all with cash, you don't. Still. If you pretend you bought it all with cash, if it goes up, you must use cash to buy it. If it goes down, you didn't replace it, so you have more cash than if you had. Prepaid, if I have more, I bought it with cash. That's really true. If it goes down, I have an expense that used no cash. I used up a prepaid instead. So I have more cash than if I replaced it. You got the idea? Think about accounts payable. Notes, or accounts payable, short-term notes payable, accrued liabilities, salaries payable, rent payable, stuff like that. If they go down, what did you pay them with? This one's easier. Cash. If they go up, what did you not pay out? Cash. So here's the deal. For these, they're really simple. We're only going to show the change, again, because there are millions of transactions, right? Even in a small company, there are thousands of transactions. If I have an increase in one of these current assets, what does that mean? Increase in the current asset means less cash. Put brackets around it. How about a decrease in a current asset? What does it mean? I have more cash. Pretend you sold it for cash. It's just fine. Okay? Works good. So getting the brackets the right way. So if I have more of a current asset, pretend you bought it with cash. Debit cash, credit that current asset. Put brackets around it. If I have less of a current asset, pretend you sold it for cash, okay? You didn't literally, but it has that impact on cash, okay? So less of a current asset, receivable and collected, right? Okay. The other ones I didn't replace. Current liabilities, if I have more of a current liability, I have more cash. And this one's more intuitive. If you have more of a current liability, you didn't pay it. You have more cash than if you had. If you have less of a current liability, what would you say? I paid it with cash, I have less cash. Got it? So always remember when you're doing this statement, you're doing what happened to cash, not what happened to the account in the balance sheet, the other account. Okay, so now that all that's crystal clear, okay, let's try and do one.
Increase in a current liability is more cash.
Increase in a current liability is more cash. I borrowed money. Right? If you don't pay your bills, you have more cash. Right? You increase your liability, current liability, you have more cash. If it goes down, though, what happens? Which pay it with? Cash. Let it be common sense. Then you don't have, because you try to memorize it, you got a 50-50 shot, right? Now just go crazy. So you see that a lot. I don't know who we is, the mouse in my pocket, I guess. Anyway. All right. So let's try this first problem. Statement, we get started. Statement of cash flows, indirect method. How about doing this? Let's write each company up here. You like that? Statement of cash flows, or cash flow statement. For the year ended. What's the date, guys? Yeah, and we'd write it out real pretty in real life. Just get something down there for me now. Okay, we're going to just do the current year. Okay, we usually show 2 years, or 3 years rather, in cash flow statement, just like on the income statement. Okay, but anyway. All right. So in balance sheet, we usually show 2 years for publicly held companies. Privately held, we only show 2 years for all operations. Okay, go down about half the page. So I'm gonna put it on the other side, but this would be the lower half of the page. Okay, and then comes investing, right, guys? Okay, and then go down. You're like 3/4 of the page down now. Financing. And let's go down to the bottom. Okay, and what happened to cash here? It went down, didn't it? Right? Decreasing cash. I'd write that down and get that right away. Get your answer before you start doing anything. Isn't that wonderful? Okay, so it went down by 7,000. We decided. Okay, beginning cash was 11, was it? This went down. Come on, Keith. Ending cash. I have less cash. Brackets around it. Ending cash 4. Okay, so we know our answer before we start. Okay, you can start wherever you want. If you want to start, though, with net income, everybody, realize that you are analyzing an account on the balance sheet named. Where does net income go in the balance sheet? Yeah, net income is going to go under operations. Or net loss will go up here. Net loss brackets around it, of course, we have less cash. Okay, net income, more cash. Pretending everything was for cash. Come on, where does net income go on the balance sheet? In retained earnings, thank you. Okay, in retained earnings. So in retained earnings, when I write down retained earnings, or I'm sorry, when I write down net income, I am analyzing retained earnings. Got to remember this. Don't put it down twice. Don't put the change in retained earnings and net income. You'll double count, okay? So how much was net income? Right off the income statement? 56. If you remember that goes first, great, I don't care, put it down, okay? But that is a credit to retained earnings, isn't it? What else do we know about retained earnings? I know the beginning. Do you guys know the beginning? By the way, we already put a check mark next to cash, right, guys? We did it before. Put a check mark next to cash. Retained earnings started at what? 92. It ends at what? 132. How much did it go up? 40. What must the dividend have been? 16. If this problem, I think, gave you the dividend, but if it didn't give you the dividend, could we figure it out? Yeah, it says 16 were paid. Sure, we know the dividend's got to be 16, don't we? You know how this thing works. Okay, so we put the net income on the statement, didn't we? So guess what else we have to put on? The dividends. Where do they go? It's equity. Financing. Dividends. You could say dividends paid because they said they paid them. It only has to be declared, though. Okay? Ta-da. It's that simple. So now you can check off retained earnings. Okay? Put a check mark next to retained earnings. Getting the idea? What account would you like to do next? I don't care. You can go in order, right? All of them. Okay? We'll leave some room maybe to do depreciation expense, depreciation and amortization expense. And we also might have gains and losses in here, maybe. So we'll leave a little room for that stuff. Okay? Just leave that. But then you know what I might do? I want to get points really fast. That was pretty easy to get points so far, huh? What else could we do? How about all the changes in the current assets? And all the changes in the current liabilities? Man, you could do these really fast. Okay? So let's max our points here. Okay, let's see, accounts receivable, what happened to it? Went up by how much? 80? I have more accounts receivable. If I had collected those, I'd have more cash. Because I did not collect them, I have less cash. So increase in accounts receivable, it seems backwards, doesn't it? Whoops. Increase in accounts receivable, I have less cash because of that. Do you guys agree? Than if I had collected it. I have less cash than my net income implies, right? Because they're in sales and I didn't collect it. Now put a check mark next to that one. Okay? I'm not kidding, it's that simple. I don't know why the author doesn't just do it this way. Easier, you think? Inventory, what happened to it? Inventory went down by how much? I did not replace it, so therefore I have more cash. You like it? You think about it that way. Or just think you sold us the cash, I don't care. And then we have prepaids. What happened to prepaids? Increase in prepaids. So I have what? Less cash because I bought the prepaids, the way you can think about it. Okay? Everybody good? Way to lay it out wrong. All right. Okay? I'm done with that one. Put a check mark next to receivables, inventory, and prepaids, okay? And now I think what I do is I'll slip down to the current liabilities in case I run out of time when I'm doing the quiz or test. And I get confused on stuff when they get hard. Do all the easy stuff first. Why not? And you can go account by account by account. I don't care. Do it any way you want. Okay? What are we making sure of, though? Why am I putting a check mark next to each of those? I don't do it twice. I did it. And notice we're doing the whole account all at once, right? We're done. We're never going to touch it again. Okay? Biggest mistakes are people write things down over and over. Some things we'll put on twice and some things we won't put on at all. Don't do that. Okay? Accounts payable. It's a current liability. It went up, didn't it? Yeah. Do I have more or less cash if I did not pay my payables? I have more. Don't put brackets around that one. Okay, guys? Check mark next to it. Accrued liabilities. Is that a current liability? Yes. Guess what happened to it? It went down. What'd you pay it with? Cash. Do you have less cash? You paid out the cash? Of course you do. Okay? Wow. Now, could there be more current assets and current liabilities? Sure. In a real company there are, but you treat them all exactly the same way. So could you get the change from in current assets in total and the change from current liabilities in total? Sure. I don't know if the author even bothered with that. I don't think they did. We won't either. You can. Some people do. You don't have to. We just add up all of operations when we're done. Okay? So we're going to have a total for operating when we're done down here. We're going to have a total for each one of those sections. So this will be total cash flow from operations. Okay, now things get harder. All right? Let's take a look. Well, by the way, check off accounts payable and accrued liabilities. What happened to plant and equipment? This is going to be a little tougher. What happened to plant and equipment? By the way, notice I'm using T accounts when I need to and I'm not when I don't need to. Always do that. T accounts really handy to analyze things if there's a number of changes. If you're only looking at the change in the current asset, why bother writing out a T account, huh? Okay? If we have more, you bet. Plant and equipment, that's land, building, and equipment, right? It starts at 500, or 420, I'm sorry, and it goes up to 500. What's the minimum amount you must have purchased? 80. But I'm not only showing the change, I'm going to show increases and decreases both on the statement, okay? And then what account goes with plant and equipment on the balance sheet? Accumulated depreciation. You guys already know this, don't you? Of course it does. That's a credit balance. It starts at 70 and it goes up to 85. This is the hard stuff now. Okay, now look, you guys. What's the minimum amount depreciation had to be? 15. It's debit depreciation expense, credit accumulated depreciation, isn't it? Everybody agree to that? It is. But what else might have happened? Oh, you might have sold some asset too. You guys agree to that? Well, when you read through this problem, what does it say down there at the bottom? They sold some equipment for 18 that had cost 30. And there's accumulated depreciation on that piece of equipment of 10. And then you look at the income statement and there's a loss on the sale of equipment of 2. Well, I could have told you that already. You can figure it out. What's the journal entry for this thing? How much equipment did we get rid of? So plant and equipment gets credited for how much? How much was the book value of it, guys? What did it cost them? 30. How much accumulated depreciation was there on it? You got to get rid of that. You guys know how to make these entries, don't you? How much was it? What was the book value? No, book value was what? 30 less 10, it was 20. There's a loss of 2. How much cash did they get? That's the 18, isn't it? Okay? And guess what? They have a loss on sale, don't they? Of how much? 2. You guys know how to make this entry. We did it before. It's just letting yourself use it, right? What do I want to put on the cash flow statement? That. I'm going to put that on my cash flow statement as proceeds from selling the equipment. Don't you guys think so? What else do I want to put on my statement? I want to show this change of 20. Because I got 30 coming out of here and 10 coming out of here. What's the difference between those two? It's a 20 change, isn't it? Everybody agree? But I only got 18 cash, so what do I need to do? Add back the loss. What's 18 and 2 add up to? 20. It's amazing. Okay? So let's go back over to our statement, and let's plug it in. Where do I put it, by the way? It's a non-current asset. Sale of equipment. It's under investing because it's non-current. You got it. Sale of equipment, how much? 18. Do I have more cash or less cash on my debited cash? More. And then you're going to add back the loss on the equipment of 2. And that seems really strange. I have a loss and I have more cash? No. The net income includes the loss, right? And it's a non-operating loss. So we add it back over here. Because I don't want the loss under operations. I want to reflect the loss down here under investing. Got it? Okay. One more. I know I'm running over today. What must have been the amount of equipment purchased? If you started at 420 and you took out 30 and now you have 500, 30 would have made it 390. What did they buy you guys? 110. And that's going to be debit, plant, equipment, and we're going to pretend it's for cash. Okay? What do you want to do with that one? How much do you want to show on your cash flow statement? Cash going out of 110. So how do we do it? Under investing, purchase of plant equipment. Wow. 110, credit. Okay? And then what? Depreciation's left is 60, goes up to 85, it must have been 25. And that's this one. We'll do this in the hour this afternoon, and we'll do it next time too, of course. Got to get that in there, and it goes under net income too. Add it back because it's a non-cash item. Okay? See you guys next time.